Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Kevin, welcome to the Australian Investors Podcast.
Thank you, Owen. Very glad to be here.
People will know your voice, may have seen you around.
Floating around.
Tell us a little bit about yourself, mate. What do you do?
I'm an analyst with Rask. I love investing. I love sort of global stocks. Love looking into ASX companies as well. I think things just kind of fascinate me in terms of how the world works. So love digging in and diving deep into various topics and things that sort of, I guess, track my curiosity. So, yeah.
Cool. That's what investing is, isn't it?
Absolutely.
It's about identifying curiosities and following it. Today, we're going to be talking about the top performing stocks. And when we say that loosely, it's not just stocks, it's other things as well from 2023. We are recording this in mid-December. At the time that you listen to this, Kev might be at a family barbecue and I may be mowing the lawn. But that's okay. Don't let that put you off. Because we've gone back, or Kev's gone back, I shouldn't take any credit for this, and looked at the top performing companies from the ASX and global markets. And we're going to talk about some of the themes that were prolific throughout 2023, because who doesn't like a good recap on what was and what has been when it comes to investing? So we will have a bunch of different names, a bunch of different companies. Lithium gets a very strong exposure in this year's list of companies.
Oh, yeah.
But before we get to that, let's talk about the top trends, Kev. So what made headlines? What was interesting to a lot of investors this year?
I think the biggest one for me really is AI. I think that really captured a whole bunch of top headlines. I think a lot of the public, not just sort of investors, have really been able to see how that technology has evolved and evolved really quickly over the last couple of years. I think everybody now has really had a play or had something to do with ChatGPT. And, when I first had a play with it, I was like, oh, yeah, it's okay. But the more I think that you do play with it and input various stuff and, really test its limits, I guess the more impressed that you become with it. And I think it's, a lot to do with basically the language engines and how much that has evolved to really deliver things quickly. And, it's not perfect. You're not going to don't rely on exactly specific things. And, the latest data isn't all built in yet. But I think that will really come with iterations. So I think that was probably the biggest thing for me, and then seeing how that trend has then flowed over into music, into art, where you're seeing things that I think were once probably too far for what was considered sort of AI and machine learning. There was all the creatives that we see around us, that was considered a very sort of human skill. And I think that AI has really proved that, some of those areas it can really tackle as well. So, yeah.
I think one of the things that you mentioned in your research in the lead up to today was this idea of how the model learns. And it probably illustrates for people that don't understand the difference between these language models and maybe traditional programming.
Yeah, I think the biggest thing there is to really separate sort of how it kind of works. And traditionally, a lot of the compute that most people know and are on most people's computers, it's powered by a CPU. So that's the main processing unit. But where AI has been able to make these leaps is with by harnessing the GPU side of things. And the difference there is that a CPU can tackle, one problem at a time very well. So it's got billions of transistors and that can sort of answer questions one at a time. But what a GPU does is it can answer multiple things at once. And so that's kind of how they call sort of series versus parallel. And the best way that I've seen that, I guess, explained is in this video. I think NVIDIA did it, way back, where it was able to draw a picture or two pictures actually. So one was using a CPU where it drew a smiley face and it sort of shot out paintballs. So if you can imagine sort of this blank canvas, and it was like going bang, 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 and then it shot eyes and a nose and a mouth. Whereas a GPU, what that would do is it would shoot millions of, or like hundreds of paintballs all at once and produce an image straight away. And I think that's the, I guess, step change in the technology and how that works. So I think in putting that into perspective, like you're talking about sort of since 2012, that technology has been able to double its compute power every 3 to 4 months. So in that sort of 10 years that we're talking now, it's gone 300,000x, which is why we've been able to sort of get to where we are right now.
The other thing that was really interesting to me in the notes you put together was, for people who aren't familiar with this, is how we program computers historically was you would write a line of code and the processor would read that line of code and it move to the next line and the next line and the next line. And you would have to like actually program that in, write it in, set the rules. Whereas with these language models, you don't have to do that.
No, that's the second part of it, really. It's basically where, like, traditionally what you would have to do with code is like put it into the algorithm or write the algorithm to be like, these are the set of rules and this is what you have to do step by step. Whereas now what we describe is you're almost going, this is the input and this is the output. So almost like this is the start and this is the destination. And then with the data that it consumes, these models then figure out a way to kind of travel that distance. And traditionally, if you're using an algorithm, it's very fixed and it's very sort of limited to how a programmer or how a developer can sort of code that up. But the difference with this is like the models can come up with basically pathways or destinations where we could never even dream of. And that's the power side of it, where, you know, we've seen sort of AlphaGo in that documentary. I don't know if you've seen that one, Owen, but basically in games of chess or other games, it can come up with moves that human players have never come up with before, because it knows it only has to get to the end goal of winning rather than sort of step-by-step moves. So it's pushing out and maybe running scenarios of hundreds of different moves every time the game progresses.
So that was interesting. So it's kind of like, instead of coding the rules of chess, you can just tell it to watch the games. And then eventually it figures out what the rules are.
It just learns.
Yeah, and then it just writes its own strategies, which is really interesting when you think about the implications of that. And definitely investors have got ahead of themselves a bit in some respects by thinking, if this company comes out and says that buzzword, I'll probably invest in it or something like this. And the companies aren't. They're probably using these GPT tools against you to say, come and invest in our small cap company that might do something AI related, when in fact it doesn't do any of that. So we'll get to some of those companies in a second. Some other things that took headlines this year. The first thing was obviously interest rates going up in Australia and the United States. As we sit and record this, expectations are that they may go the other way next year, particularly in the US, not so much here in Australia. And that's obviously had an impact on weaker companies. It's had an impact on debt-laden companies. It's had an impact on household budgets and spending. It's had an impact on consumer and business confidence. So all of those things have been quite scary. If everyone remembers back to the beginning of the year, the mortgage interest rate, fixed interest rate cliff, well, that's come and gone. It wasn't as scary as many of those headline writers had us believe. Obviously, it's all great with hindsight, but it doesn't make a lot of sense that the whole world would go to nothing.
No.
But those are things that people were scared about. The final thing, maybe if you want to talk about just briefly, is the rise of semaglutide, which is a type of, I think they call it an inhibitor, if I'm not mistaken, commonly known as Ozempic. And that's had an impact on many ASX listed companies. Yeah,
like it's probably hasn't been as felt, or the impact hasn't been as high in Australia as it is in the United States. So for those of you that don't know, it's an FDA approved drug that's primarily being created to sort of help people with their blood sugar levels and diabetes. But sort of side effects of that is weight loss. And sort of throughout the past 12 months, this product has gone bananas. So just some stats on this, like in the US, 42% of people are classified obese. But where this drug has really sort of hit its straps is Ozempic accounted for more than 65% of total prescriptions at the end of 2022.
Wow.
So it's pretty crazy. It's kind of flown off the shelves and been off in demand. And it's almost to the point where the people that need this drug for diabetes can't actually get it. So that's the kind of effect it's had. What it basically does is it slows down and suppresses hunger. It slows down the digestion. So people basically feel fuller and then they're consuming less calories because of it. So it's seen an average weight reduction of around 15% versus like placebo in its testing. So that's on par with basically metabolic surgery, which is very invasive, very kind of serious medical treatment. So I don't think I've heard as much of it sort of go around in Australia, but over in the US, it's really had a big impact. And the flow-on effect for investors is that a lot of medical companies, even Australian listed ones, have been severely affected by this. I think maybe some of the sell downs from this have been overblown personally, but I'd love to get sort of your take on that.
Yeah, that would be my take as well, to be honest, Kev. Particularly with like the likes of ResMed, which is a sleep apnea device maker, and CSL. Both of those businesses have been impacted by this because fewer people with things like obesity means not as many people with sleep apnea and these types of things. At the end of the day, though, those are still two wonderful companies, and those could present the buying opportunities for people. But Ozempic and those types of businesses are not on our top stocks list, Kev.
No.
So you went and run, and we will get to the kind of, I guess, the minutiae of this in a moment. But you went and run some screens on the ASX, and you looked at all of the companies that have performed exceptionally well on a 12-month basis.
Yeah.
So it doesn't line up perfectly with the end of the end of the calendar year. But you looked at these companies. And if we just did a simple share price then, share price now, what are the types of companies that come out on top?
I hate to say this, but they're kind of more speculative companies. So the first kind of screen that we ran, and we ran it on Ticker, is for all ASX companies, all industries, and with a market cap of greater than 100 million. So that would capture quite a lot of the market. And in the results there was pretty interesting. Like you've got some really amazing share price performance, and well done to any of the investors that have, been along for the ride here. But the top one there was Wildcat Resources, which its ticker is WC8, $1 billion market cap now, lithium miner. Basically, in its results, it's announced some pretty big lithium discoveries. It doesn't have a whole lot of cash in the bank nor revenue at this stage. So that's kind of the...
super early stage.
Still very early. Definitely an explorer. And that's kind of the common theme with a lot of the top 10 here. Like you've got things like Azure Minerals as well, another lithium explorer. They also raised a whole bunch of money, but they're also burning a whole bunch of money, around 13 million a quarter at this stage.
Wow.
Spartan Resources as well, another one, which used to be called Gascoigne Resources, a gold explorer. Again, not profitable. I think in FY22, they were just cash flow positive. But there were another two there, Clearview, again,
Just like the glass technology. We've been asked about this company before, where it does where you could turn your glass into some sort of like solar panel-like material.
Correct. Very exciting technology, if they can get that developed and then get it to market and commercialized. To date, though, I think they just signed a small $250,000 contract with a solar greenhouse, but again, burning a whole lot of cash, not that much in the bank either. So these are very early stage businesses, and a lot could go right, but equally as important, a lot could still go wrong.
Yeah.
So
So in the top 5 then, we've got Wildcat Resources, Azure Minerals, Clearview, ticker symbol CPV, Spartan Resources, SPR, and Visan, which is a much smaller water environmental company. So Wildcat up 2,700% or 27 times, 1,500% for Azure, and the rest up in the hundreds of percent. So one of the things that people will be realizing as soon as you do a screen like this, Kev, whenever you go, show me all the best performing stocks on the ASX, and you do it today, it will show you all of those tiny little speculative things from a year ago that have now performed well.
Yep.
So how can you get around that?
So what we do then is basically just go, hey, let's put a revenue hurdle rate in there for them. So the one that we used was greater than $5 million of annual revenue, which isn't a huge step either. But I think that at least knocks out a lot of these companies that are much earlier in their sort of journeys. So
because some of those companies had like $1 billion market cap, but no revenue, which is
extraordinary.
Yeah.
And, you know, for investors there, like a lot of that is really, like, I'm not sure if you can even call it multiple expansion, because if they're pre-revenue, aka not earning any money at all from external sort of customers and clients, then, you know, there's a lot built into that share price already, and there would need to be a lot that goes right.
Yeah. So it's basically like a hope as an investment strategy, which doesn't always work. You're basically betting on something massive happening in the future. So we've got companies, we've excluded some metals and mining companies and tried to get towards more industrial style businesses. And the list come out with Step One Clothing, STP, Doug Technology, DUG, Satire, CTT, Nuix, which is an embattled company, we'll get to it in a minute, NXL, I think it's Chrysos, yeah, Corporation. I know my friend Ryan Newman always talks to me about this business. C79 is the ticker symbol. Codan, CDA, which has been around for a long time. Duratec, DUR. Symbio Holdings, SYM, Audinate, which many of the listeners are familiar with, which is an audio-visual technology company, 88. And finally, Hello World Travel, HLO, which many of you will know as a travel agent. Bit of a mixed bag.
Yeah, and I think the common theme here, along with the global stocks or the US stocks that we'll get into as well later, is that very much a turnaround story. So if you really dive deep, I think Audinate's the only one that's kind of hit all-time highs, but, you know, we had this massive run sort of during COVID, and then this quite a big fall with the growth sell-off. So a lot of these businesses and their share prices are kind of recovering from that. But, you know, stepping into the first one, and no pun intended, is the bamboo or the premium bamboo undies company that I'm not sure if you own a pair.
I do not, but I do see people wearing them, Step One undies. I remember when this hit the market, their PR company reached out to us to see if we would interview them. I declined because I wasn't 100% sure if it was a good idea. And lo and behold, it fell pretty heavily, but then it bounced off the bottom, obviously. I don't know about anything about Doug Technology. That's probably the most interesting sounding business.
Yeah, I don't know that much about it either, but just for the brief look that I had, it's sort of analytical software company and data centers. They talk about sort of this unique cooling technology, which allows their compute to sort of go to really high performance. They do things like seismic processing. So that's kind of like weather stuff and forecasting and modeling. The big thing with this business is their services revenue exploded during the year. So that was up plus 70% for FY23, up to 40 million. So this is like, you know, real revenue, real results, and that has really translated into their operating cash flow, which went from, you know, burning money to plus 13.3 million positive. So wow, pretty impressive.
That's a big inflection point. Yeah.
Yep.
Next up was Satire. Satire is CTT on the ASX. It does, if I'm not mistaken, there's a lot of secondhand luxury items. So you can get handbags, you could get shoes, you could get all that sort of stuff on there.
I think it's actually mainly new. So
right, is it?
I think early days, it was called sort of a grey market seller. So it didn't officially have, I guess, the rights to sell these products. But what it did was it did deals with distributors, behind the main brand and then were selling these at a discount. So you would have, as you know, with sort of luxury products, there's a huge markup. So by doing these deals with distributors, the distributors were still happy, companies were kind of happy, but they were sort of getting discounted, and, you know, savvy shoppers online were getting a pretty good deal. So pretty impressive business in terms of growth, actually. So if you really dig into the numbers, like the growth rates have been hyper growth. So even in sort of the latest quarter, you know, against sort of comparatives, it's up 92% revenue.
Which is pretty impressive.
Particularly for the year that we've had in terms of everybody, I guess, tightening their wallets and purse strings. The founder is an interesting cat. I think holds a bunch of stock, you know, and it's usually what we like to see, but super private. You won't see many articles or many deep dives, any media about him. That's probably the question mark, and he has been selling down across the years. So that's probably
Put a bit of pressure on the share price.
Yeah.
And if I'm not mistaken, they do spend a lot on marketing. They have a big marketing budget. So the top line growth, impressive. But investors obviously want to see cold hard cash at the end of the day as well.
Yeah, I think the key there is it's a very capital light sort of business model. So they don't actually hold any of this stock. So when they're doing these deals with the distributors, they're the ones that then ship it out. Like it, you know, it allows Cettire to basically turn over all the profits and cash flows that they make pretty quickly.
Yeah, those inventory turns would be pretty good if you're not owning any of it. Nuix is another company that people will know did IPO not too long ago, a few years back, and was a bit of a darling for a very, very short while. Then got absolutely thumped for reason after reason. I think even, it can be, correct me if I'm wrong here, Kev, but I think even for a time there may have even been a class action or something like this that was on the cards.
I think so. And this was back when, you know, the share price, as you said, was flying high. And so it's an analytics software business. There's been, you know, a sort of series of downgrades and things that have happened since. Basically, it's been a turnaround. I think a lot of investors have seen that their sort of EBITDA has grown up and sort of recovered strongly. I think I would probably caution investors or sort of draw their attention to the cash flow statement, where like a lot of costs are still being capitalized through there. So any of the operational cash flow that is being generated there is kind of whittled away by some of the CapEx spend. So I'm not sure how sustainable that is, but yeah, definitely been a good year for them. But still, yeah, I think there's question marks on the business model.
Okay. Is there any other companies you want to focus on from that list before we move to the US?
Probably just the last one is Chrysos.
Yep.
Not sure if this might be flying under the radar of some investors as well. It's a spin out of the CSIRO, and basically their tech. They build machines and the photon assay technology, which is basically high-powered X-rays, that lets miners and laboratories basically have faster and more accurate gold analysis. So imagine a miner or a lab, they dig a whole bunch of samples out of the ground to test for basically gold and how much gold is in there. Their test can basically do it, you know, way faster in a matter of minutes versus 3 to 4 hours, and it can do it with smaller samples. This business is definitely growing very well, but there is a capital heavy component to this. So the business model is that they build these machines and then they lease it out to these miners and labs. The only thing is that these machines cost a lot of money to build. I think I had it down here. I think it was around 3.6 million per unit. So
wow.
All the cash that they've raised and additionally raised from this is being basically consumed by how quickly they're producing them machines. Now, there's quite a bit of demand there, but if you look to the cash flow statement, definitely some good cash flow there, but then the CapEx spend is getting and increasing pretty high as well. So
wow.
Yeah.
If you've got to spend that much on a unit, you want to be charging a lot for it. Wow. Okay. So the other part, which I know you're very passionate about, is, and we've got two more parts to go. One is the US companies, and I can just list off the top 10 performing US stocks at the time of collecting this information, which is NVIDIA, which we'll come to, Meta, Accenture, Royal Caribbean, and Carnival Corp. So those two that people will know maybe from the cruises or something like this. Palo Alto Networks. I don't know how to say the next one. Pulter Group?
Yeah, I think so.
Yeah, I haven't come across this before. Advanced Micro Devices, otherwise known as AMD, Tesla, and Fair Isaac Corp, or FICO, which is getting a lot of attention lately. Now, let's start at the top, Kev. We have NVIDIA, which is probably tying into the original point at the top of the show, which is that AI needs GPUs.
And NVIDIA is the biggest beneficiary and being the market darling of the year, I'd say.
Yeah, definitely.
Just incredible market cap appreciation from this business, which is a wonderful business, by the way, like capital light, and it's got a founder and a CEO that has been a visionary really in the space. So he sort of understood that GPUs could play a major part in technology and our lives, and he was the one that bet big on that. And the business is really benefiting from sort of years and years of, I guess, trying different things, and now getting to a stage where its technology is really powering, I guess, all the next gen things that are going to really benefit and create a lot of value for the world.
I remember when I used to put an NVIDIA GPU in my old PCs that I had back in the day. Don't have it anymore, obviously just use Macs, but that was definitely one of those things where I was like, this is kind of cool tech, and I was really interested to see where the graphics could go. So NVIDIA, as a natural beneficiary from the surge towards more computing power, parallel computing, has been a huge winner. I remember reviewing some of the results early this year, some of the quarterly results, and thinking, this is already near $1 trillion company at the time. I was thinking, maybe this is just all hype. Maybe this company is just growing out of nowhere, which a lot of the Aussie tech companies do too. So just share price goes up for not really many rational reasons. But I remember looking at the swing in profitability, just thinking, oh my Lord, like it has the financials, the fundamentals, the profit, the cash flow to back up the share price rise. And I was like, in a year from now, even though this thing has gone up multiple times, it could actually look cheaper in a year because the profits are rising so fast.
Definitely. I think there has been a lot of hype in the business, and I think it has delivered to some extent. Like there's been, right now, like the forward earnings is high, but it's not outrageous. Like there's definitely been companies that, are trading on multiples that are much, much higher than this. But I think what sets NVIDIA apart is it really is powering a lot of the things that are going to change this world. Like if you look at the basically things from cloud computing to data centers to AI and autonomous vehicles, robotics, like they've got their kind of finger in everything. Even if we look at, how much, I guess, their video cards or the price of their video cards have increased, like that's a substantial step up in pricing, and it shows the pricing power that this business has. You look at things like the A100 server boards that are in a lot of the servers to train things like ChatGPT, like they're shipped in basically packs of 8 and they cost $200,000 US. And, I think there was a whole thing on Twitter about this where a lot of the tech companies were bragging about how many of these they had. And I think Microsoft's got, used 10,000 of those just to train ChatGPT. So,
wow,
pretty impressive numbers. And you think about the demand that's still coming for a lot of this, I think that's going to be sustainable to a point.
One of the companies that's maybe not directly involved in AI, but seems to have benefited in a big way, and it's probably just because it uses so much computing power, is Meta, or otherwise known as Facebook, which owns Facebook Messenger. It owns WhatsApp, Instagram. It owns Oculus and a few other VR businesses. These types of platforms tend to benefit from better technologies because they can serve more reasonable ads, better content, these types of things. But Facebook is probably one of the most surprising names on this list for many people that thought that Facebook was dead a year ago. And now all of a sudden, folks have just woken up and realized, hey, Facebook's back in town. It's multiplied this year.
It was a strange one for me. Like, I know the threat of and the rise of TikTok was meteoric. So I think that was playing on a lot of investors' minds. It was almost like Facebook, there's always been talk of Facebook Blue, the core product, the original product sort of starting to lose users or growth really tapering out. But as far as I could see, people were still using Instagram, Messenger and WhatsApp as much or if not more than what they had previously. So that always seemed a strange one for me. And it got down to a point where sentiment turned so bad that I think the business was selling for, like 6 times earnings or something like that. And this is a business that's got no debt, bucket loads of cash, a very capital light business that, if you look at the metrics where user time and app downloads, they were all still pretty positive. Yes, the ad dollars had slowed and actually dipped, but at the core there, and I think a lot of it got pulled up in the the bad sentiment about sort of their metaverse stuff just burning bucket loads of cash, but the main core business of selling ads while everybody's sort of uploading content and producing the product, like that was always still there. So you've got a very strong business that offsets all those losses, I guess. So yeah, to me, it was a strange one that it got so low and really sort of a big turnaround.
Huge. Another one is Accenture, which has been spoken about on the show before by the likes of Stephen Arnold from Aorus. Accenture is the global consulting business, does a lot in the tech space. One thing that happens with these types of global behemoths is that people often see them cutting jobs and think that's a bad thing for their business. But oftentimes they cut jobs and they realize that they can still keep growing with this reduced workforce, which cuts a lot of costs out. So it's not great for people that get laid off, of course. But these types of businesses, these kind of like A+ or the gold standard consulting businesses tend to have a very, very good track record of capital allocation and also like shareholder profitability.
I think it flows from sort of having customers and clients that have just been with them for the journey for a very long time. So you see, like if you're a client of Accenture, you're going to them for strategy, consulting and IT services year after year. And I don't think that really changes a lot, even with sort of market sentiment and downturns. Like I think they were saying, so many of their customers are always with them, and it's a pretty reliable and it's a high quality business, right? So you see them lay off, I think it was 19,000 jobs or something like that, and it's been a very common theme with a lot of the big businesses, especially in the US, where I think they kind of got a bit bloated. Times were good, rates were low, there was money to spend, and then all of a sudden that changed where the cost of capital went up, and investors and shareholders were like, well, why are you spending all this money on some of these things? And really took a magnifying glass to expense items. And with Accenture, they were able to automate, I think it was 13,000 jobs, or sort of reskill and deploy these people into other positions. So margins sort of are really up and up in a big way. But the main theme here is that it's a story of multiple expansion rather than real top line growth for me. So I think some of these very impressive gains from 12 months ago, I don't know how sustainable they are.
Yeah. Well, it's interesting. It's the share price up 150%, and it's a huge company. And so you got to imagine if it's up 150% and the profit or price earnings multiple has gone from 23 to 31-ish, that's a near 50% increase just in the expanded profit multiple, or the valuation just being stretched. And so for a lot of investors, you probably don't want to bank on that happening again.
No.
Particularly if we do see some more, pain in terms of economic pain and those types of things. But it's going to be interesting because this has been a high quality business for decades. So
Absolutely.
It will still be a high quality business. It's whether or not it can continue to demand that multiple. The two final companies we might just pay some quick lip service to, Kev, is Royal Caribbean Cruise and Carnival Corp. These businesses are up 143% and 124% respectively, which basically translates into these cruise lines becoming multi-baggers in 1 year. I'm guessing a lot of it's just due, frankly, to timing, as in coming out of COVID, they're in absolutely awful shape. No customers anywhere in the world wanted to jump on a cruise during COVID. Fast forward a couple of years, they've returned to maybe near business as usual, I don't know. And all of a sudden, they've gone up.
Yeah, and I think it's this is the classic turnaround, right? Like, these two big businesses and very sort of capital heavy businesses went from, earning really good money and pretty reliable, pretty stable sort of cash flows to then, having no customers and then still supporting this huge asset base and balance sheet. So they were burning, a lot of money. And now that, the customers have returned, passengers have returned, revenues are getting very close to sort of the pre-COVID highs. And like they've gone from bleeding cash to now producing cash again. What I will sort of, let investors know is maybe have a look at sort of the balance sheets of these businesses. While they are in a pretty strong position cash flow wise, like because they've had to go through the struggles with COVID, they have accumulated a lot of debt. So in the case of Royal Caribbean, net debt's gone from 11 billion to 20 billion.
So that's net debt. So that's after you subtract the cash.
Correct. So, and with that debt as well, like with rates going up, the cost of that financing that debt is, I think, having looked into the notes, like they're financing those at greater than 10%. So we're talking about 2 billion just in interest expense, which
huge.
If you look at then the operating cash flows, that a lot of that gets wiped out, and it's a similar story with Carnival Corp. Net debt went from 9 billion to 30 billion, and also share counts have been on the rise. So if you look at your slice of the business pre versus post COVID, and now, you're owning less of that business as well. So
less of the business, lots of debt. And it goes to show, and when no one really saw COVID coming pre-COVID, but at the same time, it shows the businesses that have no pricing power in effect of like they're dependent on some outside force. And we see this in the travel industry time and again, in the airline industry, capital intensive businesses with a lot of heavy things on their balance sheet, things like building, things like property, plant and equipment, ships, these types of things, lots of staff. They're great when everything's good because they can magnify the returns, kind of like a loan on a property. It's good when the going's good, but when it's bad, it gets really bad really quickly. And you probably don't want many of those stocks in your portfolio if you are thinking about investing in anything like that. As we come to the end of the show, there are some ETFs we've got to go through. The top performing ETFs, I'll run through the list really quickly. We've got the CRIP ETF from BetaShares, Crypto Innovators ETF, CYRP, FANG from GlobalX, that's the GlobalX FANG Plus ETF, FANG, ALNAS, GlobalX Ultra Long NASDAQ 100 Hedge Fund, that's LNAS. The HYGG Fund, which is the Hyperion Global Growth Companies Fund, it's a managed fund as well. SEMI, which is the GlobalX Semiconductor ETF. Uranium, or URNM, from BetaShares Global Uranium ETF. MTAV, which is the BetaShares Metaverse ETF, similar to the Facebook one. So there's 7 there. I can maybe pay some lip service to these really quick. Crypto, the ETF was one of the worst performers of all time in terms of destroying shareholder or in ETF investor capital after its IPO, after its listing on the stock exchange. It's now made a bit of a comeback, naturally. FANG, Really concentrated on those top 10 stocks from Global X. We've talked about that a lot. Drew called it one of his best investments ever. Credit to him. LNAS, which is a leveraged product, which means that it basically magnifies the returns up and down of the stock market of the NASDAQ 100. And as we know, the NASDAQ 100 has performed well. Hyperion, which is an active fund manager, big business. I think it's one of the Pinnacle affiliates. I think it's part of the Pinnacle Investment Management Suite. Again, pretty concentrated, has a lot of companies like Microsoft, ServiceNow, Spotify, Amazon in the portfolio. Global X Semiconductor ETF, a play again on AI and the usage of chips and these types of things. Things like lithography is in there as well with ASML, NVIDIA, so on and so forth. Uranium, I've made the joke to you before the show that long on promise, short on delivery have been a lot of these uranium companies. Again, quite, concentrated, it's fair to say, to put it lightly. Finally, MTAV is a metaverse ETF, and as you would imagine, things like Nintendo, Meta, NVIDIA, once again. A lot of overlap if you owned all of these ETFs with NVIDIA by the sounds of it. Those are all up in there. It's more of a gaming style ETF at the end there. So you can chuck those on your watch list. They're not any of those 7 are not really the 7 that I cover that closely, would probably all fall into the satellite component of a portfolio. Maybe Hyperion, maybe Fang, you could have a small allocation in a growth portfolio in your core. But 3 fun things to end the show, Kev. This is what I really wanted to get to. We talk about investing and the best investments, like the stocks, what goes into our portfolios from one year to the next. You've had quite a year full of really interesting things that you've done. So you've come to the table with 3 investments that have been, I guess, in yourself or in your personal life. And I'm curious what these 3 things are.
Yeah, the first one, so I got married last year around sort of this time, and shout out to my lovely wife, Amy.
Congrats, mate. Congrats.
Thank you. We had a bit of a delayed honeymoon. So in April this year, we went over to the States and we did Mexico as well. And being the lovely wife that Amy is, she actually let me go to Berkshire Hathaway's AGM. So yeah, it's the first time I ever went. And with obviously the sad passing of Charlie just recently, very, very lucky timing. So, as an investment nerd, just an amazing experience to spend a couple of days there. So for anyone considering, I would really urge you to sort of make the trip. I actually have a bit of a special thing here for you, Owen.
I was wondering what this is. I thought you just brought a treat into the studio.
It is a treat, but this is See's Candy Peanut Brittle. So
wow. I'll grab a little bit.
This is actually all for you. So. Oh,
really?
Yeah.
Wow. Okay, I've never had See's Candy. So
I've never had it as well.
Obviously a Berkshire company.
It is.
I'm going to crunch this. Apologies if it's on the microphone.
It is. And something that, until you try it, you're like, is it that good? But there's a reason why these 2 love this, and highly addictive. And thank you for my brother-in-law who brought me a box back from the States recently.
This is seriously, seriously good.
It is like crack, man. It is very good.
So this is what? Peanut Brittle?
Peanut Brittle. It's what if you kind of rewatch any of the Berkshire days that are on YouTube, you'll see the 2 greatest investors probably of all time just munching on a box of these. So
wow.
Very, very good. Highly recommend anybody try it. And yeah, I just love the meeting.
Just really quickly, Kev. See's Candy, because we don't have it here in Australia. This is seen as like a premium candy in the United States, right?
Correct. I think a lot of people sort of give it to partners or dates or wives, and especially on Valentine's Day and Christmas and birthdays. So
naturally, you brought some for me.
Absolutely.
Makes sense.
But yeah, I also, for any listeners out there, I tried the little sample pack of various other chocolates and things, and the Peanut Brittle is definitely the best one. So stick with that for now.
I wonder if you could buy it on Amazon. That'd be so cool. Okay, so I noticed that in your notes you also had some gems, maybe some quick quotes that you could throw at us that you got from Messrs. Munger and Buffett.
Yeah, the first one I think was from Warren himself. So he said, write your obituary and try to figure out how to live up to it. For business, you want to make sure that you don't make any mistakes that take you out of the game or come close to taking you out of the game. So I think what he's talking about there is just have that consistency in performance and, really take away the risk where, you might be able to suffer any very large losses. So basically,
Carnival that we just talked about.
Kind of let compounding do his thing. And, it's obviously his number one rule is to sort of never lose money. So other ones that I think, that kind of stuck out to me were one from Munger. He goes, it's so simple in terms of his life advice. You spend less than you earn, invest shrewdly, avoid toxic people and toxic activities. Try to keep learning all your life and do it with a lot of deferred gratification. So just, really wise in the things that they delivered. Like Warren, especially at the meeting, was, as energetic and as sharp as ever. Charlie, still was, they lasted the whole day there answering questions from investors. And at 99, that's no mean feat. And I definitely sort of tip my hat off to them. There were people in the crowd that were getting very tired and sort of drifting off, and those two were powering on.
Incredible, all this candy and Coke. I'm glad there was another quote here that you had, which I listened to it all back through, I think it was like CNBC or Yahoo Finance. They all have the live stream available. I think it may have been on YouTube. And you can watch the most recent year's AGMs on playback. And I loved this quote when I heard it. I absolutely loved it. So I'm glad you put it in here, which is from, I think it was from Warren at the time. Correct me if I'm wrong. I've never known anybody who was kind that died without friends, but I've known plenty of people with money that died without friends. And he said a few things similar to that throughout the day. And I just love that quote because it's basically that one and the first one that you mentioned. In fact, all of them, it's basically start with the end in mind. It's like, what is the ideal life and how do you want to be remembered? How do you want to be seen by others? Just live up to that expectation. Do everything you can to move towards that, which is just wonderful. Okay. The second thing that you've brought up is more recent, but also travel related.
Also travel related. So a bit of a common theme as well with the things that I've talked about. I was lucky enough to visit China and Hong Kong recently. My mum is born in Hong Kong and my dad is born in China and I was born in Australia. So I've been to China once and Hong Kong once in my life. And they were both when I was very young, and the trip really sort of opened my eyes to how much that country has actually changed. China in particular, I've got a write-up coming up for members that they can read shortly, but just the size of change and the scale of change in that country absolutely blew my mind. It was wild. Just high-speed trains, the EVs that are coming, that country is producing, the road network that they've been able to produce, the tech as well. It's just how many people are in that country and the size of the cities are just mind-blowing.
So you've done a full write-up on this, and you've also got photos of your trip throughout, of the infrastructure, of the cars, of the properties and all these types of things. And you got the kind of like boots on the ground look at it all. Because a lot of people don't go there because it's so hard to travel to, which you do have some tips in your write-up. And by the way, Kev's talking about the write-up for members. So if you're a member of Rask, you can expect to see a lot more from Kev in the future. But I was actually taken back by some of the things you said, because in the lead up to that, you and I had spoken about how whether or not to invest directly in China or whether to use like the S&P 500 ETF and get some exposure through things like Starbucks. And some of the things that you sent through was just, it really made me think about how to go about that. For anyone that owns a Tesla like me or owns Tesla shares, I do not own Tesla shares. Did you see many Teslas on the road when you were there?
In Hong Kong, they were everywhere. So almost saturated in that market. In China, they're definitely there as well. But I think what's coming, and I think Elon actually mentioned this recently, is the competitive threat that is there and the amount of different EV brands that are coming. Australia might actually see this a little bit more delayed than the rest of the world, purely because we're the right-hand drive builds, and they're usually like 2 or 3 years behind. But the technology that is in them, and even the car designs, like they're very good-looking cars, and they're stacked with tech. And these are companies. Some of these companies are only 3 to 4 years old. And I think for a first-gen release of these cars, it was very impressive for me to see in person. And the quality's there. Like, they definitely make, cheaper stuff as well, low-cost cars. But the premium stuff can compete with any of the European and worldwide counterparts. So,
wow.
Yeah.
So we're talking about brands from China, car brands from China that create electric vehicles that most of us here in Australia probably don't even know exist.
Or have heard of. And like I urge probably listeners, the best thing is to just Google and YouTube some of these and see some of the reviews that are out there. Like the designs are cool, the tech is very impressive, and more importantly is the cost point. Like these are going to compete very, very hard in an industry that, is low margin, and the winners here are going to be the consumers.
Mm. That's the big driving force behind Tesla cutting its cost as quickly as it can to try and compete, right?
Mm-hmm.
To try and drop the cost so it gets their cars before any others in the hands of more consumers.
Yep.
Not just in the United States, but in Australia, in Europe, everywhere. Because there's only a certain time in the sun that you have before you have to face realities of capitalism.
Yep.
Semi-capitalism, maybe, if we're talking about China. Final thing, which is a bit of fun, something that you've invested in personally.
Yeah, a YouTube premium subscription. I'm a notorious tight ass, so I try not to pay too much for any subscriptions, but man, I love my YouTube subscription. I'd hate to see how many hours I've actually clocked up on YouTube, but it would be a lot. And yeah, just like as a curious dude, I love seeing such cool content, such unique personal content being created. And like a couple of my favorite channels are Alex, French guy cooking. I love cooking. He does some really cool stuff in terms of diving deep into recipes and going into Italy and other different countries and seeing it firsthand.
Cool.
Bo Miles, who's an Aussie guy, they call him the backyard adventurer. He kayaked, from Vic to Tassie, ate 40 days of canned beans straight for every meal. And then ran
not on the Tassie trip.
Not related. And then also did like this 24-hour mile marathon where he ran a mile every hour and then did other tasks. It's just cool, funny, wholesome content. And then one last one is Nathaniel Drew. He sort of goes into languages and culture, and he it's pretty amazing what he can show you to do. Like I think he learned Italian in like 7 days or something, or learned Italian to a very impressive level in 7 days. So wow. Just some cool stuff out there.
Wow. Okay, so there's some good recs for anyone. Premium, YouTube Premium. I do have that as well, and I got to admit, I just love skipping those ads.
Oh, yeah.
So good. And you get some original content if you've got kids and that. China trip, full write-up, be out in Rask soon. Loving the quotes from Berkshire. Congrats going there for the last one. With the two of them together. Lots of ETFs, more on the thematic side as you'd expect a leverage one. Some cruisers making their way up the list of the top 10 in the US. Clearly in the United States, the top 10 list from the S&P 500 are much superior, high quality compared to some of these Australian names that made the top of the list, that more of a bounce, if anything. And it just, for me, emphasizes yet again the explosive growth of already large companies in the US where there's so much innovation happening. We saw companies like Step One, Doug, Satire, Nuix, and how do you say it? Chrysos. I always get it wrong. All in the list. When you made that filter, exclude companies with no revenue. If you don't put that filter on inside your ticker terminal or however you screen for companies, you're going to end up with a lot of wildcats in the mix. And that was Wildcat Resources making it number one with a 27 bagger in 12 months. But still, no revenue, no sales for that massive company, which is a very big red flag for me. Not the type of thing that I invest in, but congrats to everyone that has invested in it and did enjoy that run on the way up. So this was 23 stocks or 23 investments in 2023. I think my favorite three were the last three, to be honest, Kev. It was also quite shocking to see so much debt on those boats. I reckon if you printed all those US dollar bills and you put them on the boats, they'd probably fill up a whole cruise.
Could be a Titanic.
It could be a Titanic situation. Anyway, man, this has been heaps of fun. Thanks. I think this is your second episode on the Australian Investors Podcast. I think you appeared years ago, but I'm so delighted to have you back in the team. So, mate, thanks for taking some time to join me.
No, lovely to be here, mate. And it was loads of fun.
Yep. Happy New Year.
Happy New Year. Merry Christmas, mate.